One of the items we looked at, we went through a transaction last year with a client that had, it was a service company. They had very few tangible assets. They collected their receivables very, very quickly, but they didn't have a lot of assets on the balance sheet. And one of the things that the bank asked for was a quality of earnings report. We're starting to hear that term more often. Banks requesting that from the accountant. So, Jim and Pat, why don't you talk about what that quality of earnings report looks like, what it includes, what risk factors you typically see in there?
Well, a quality of earnings analysis is commonly referred to when you hire a very competent accounting financial advisory firm such as Chrysler Miller
we will pay you later for that.
to come in at some point during the acquisition and look at the targets, books and records, and they're not performing the same level of scrutiny as they would if they were performing an audit. But it's validating some of the adjustments to earnings that maybe the buyer is proposing, or excuse me, the seller is proposing. It's understanding the financial controls and reporting systems within the organization, and preparing what is called a quality of earnings report that they deliver back to you and tell you the good, the bad, and the ugly that they found through their analysis. Depending on which side of the equation, whether you're a buyer or seller, when you're a buyer, it's a quality of earnings analysis. When I'm representing the seller, I call it the witch hunt, which is they're paid to find things that may be wrong with the reporting, or where they differ in terms of reporting. These accruals, but I think just to add on to that, I think that speaks to, again, if someday down the road you might be a seller, if you have a quality firm like Chrysler Miller doing an audit and going through the process, you're much better served to withstand one of these Q of E analyses, because then you can kind of put the two accounting firms together. They can duke it out on vacation accruals all they want. You don't have to necessarily be involved in it. And also you've built controls and a system where you're not just waiting to year end to clean everything up, because transactions never happen exactly based on year-end numbers. They don't, and if you don't have good interim reporting, it can be a problem. So that's a little off topic, but again, I think it speaks to the QV analysis.
Yeah, no, I would agree with that. The only thing I would add would be, as buyers in the lower end of the market, typically you are acquiring a business that doesn't have an audit. So, you've either, luckily, or possibly they'll have a review. More times than not, you'll even get something that you're looking at just tax returns or compiled financial statements. So, for us, the QOE is one of the most vital steps in due diligence to confirm these numbers that they're putting forth. And, as you said, just at the very end, I don't think we've ever done a deal that was at year end, or literally just after year end where you had that. So it's always interim numbers that you're looking at. And, businesses always want to sell based on, especially if they're doing well, they want to sell if their interim numbers are, going through the roof. They want to sell you at what is that number there, not what their last year end, cash flow was. They want to sell it our trailing 12 months at this point, or even what their run rate is, going forward, which makes it even more important to have somebody independently, go in and confirm what these guys are putting forth is true. As well as, really, as you mentioned, the financial controls that are in place. It gives you a little bit of a window into, the management of the business and how they run it, and how much you'll have to change or do to bring them into, the way you run your business.